So thanks everyone. Let's get started. So just to start off, we're going to be a heap leach project, so the grades are a bit lower. So I always like to start with this cost curve on Australian producers and just point out that the highest grade producer, Costerfield, is sitting up there at the top of the third quartile, and one of the lowest grade producers is sitting down there in the first quartile. And just to make sure everyone's aware, grade is not king. All right, so here we go. So the Pantanalloy Gold Project is located in, I don't know how I'm meant to read that, but it's located in Chile, in the Andes, in the Maricunga Gold Belt. And this project's quite unique. It was owned by Anglo, and what we're aiming for here is projects located in low-cost jurisdictions, you know, low-cost environment, and it's all about our position on the cost curve ultimately, so we can produce a profitable product. The project's got access to all infrastructure and so on. So it's got a million ounces, or 1.05 million ounces in it, and 80% of that's measured. So this is really important. When you've got an inferred resource, to go from inferred to indicated, W drilling, indicated to measured, W drilling again. So it's got a really good resource base. It's 0.69 grams a tonne. So in our heap leach universe, which you can see there, it's one of the higher grade projects. And this is where it gets really interesting. The Maricunga Gold Belt has 100 million ounces in it, and you can see there, the red numbers, that there's a lot of big projects here. And in that dotted circle, which is about 40 kilometres radius from our project, is 60 million ounces of resource. So we're in a really, really rich belt. The project area itself is about 110 square kilometres, and you can see on that chart that there's a little green area up the top, not right at the top, but near the T1. That's the million ounce footprint. And then right up the top corner there is the Vulcan project, that's 11 million ounces. And what we're doing here is we're aiming for those light coloured areas. They're volcanic alteration belts. So you can see that we've got 1 million ounces in this small green footprint, and then we've got this block area with T1 through to T7, that's target 1 through to T7, with big alteration areas, and ultimately that's what we're targeting. So we're going to take the current mineral resource of 1 million ounces, we're jorking that up at the moment, that should be ready by the end of November or so. That'll bring in more ounces there, we go into feasibility, and then we start expanding the project throughout the rest of the block. You can see here in this soils profile on the right-hand side that soils trend is about 5 kilometres long and 1.2 kilometres wide, and our project area, which is around 800 metres long by 200 to 600 metres wide, sits smack bang in the middle of it. So there's just around the current mineral resource, there's a huge amount of upside, and this is where we see a lot of opportunity in the project, a lot of immediate opportunity over the next 6 months or so. The project itself has had over 20,000 metres of drilling in it. It's had some feasibility work done on it in the 2010s, and you can see a block model here, and you can see in the middle of the block model high grade zone. So this is our inventory growth path, and we have 4 steps for our inventory growth. First, what we're going to be doing is looking at reducing our cut-off grade, which is in line with our neighbours. So right now we're at about 0.3 grams a tonne, we'll drop it to 0.15 grams a tonne. Second, we're going to look at bringing up to date the economics up to date. So the current pit-constrained mineral resource is based on a gold price of $1,035, so we'll bring it up to date to economics of today. Then we're going to look at expanding the resource with extension and down dip drilling in and around the current pit-constrained model, and then we're going to expand it throughout T1 through to T7. Here we've got some great cross-sections. So actually if I back up here, you'll see these section lines on there. I'm going to show you 2 section lines. I would show you more, but I don't have much time. So you can see here some fantastic sections. On the left-hand side, on both sections, we've got that green area. That's the pit shell estimate. for the current resource, and then we've got drilling under it. So on the left-hand side, our deepest hole is 700 metres in length and finishes at 0.7, so in mineralisation, and that's got a vertical depth of around 600 metres. The current pit shell mineral resource, pit shell constrained mineral resource, has an average depth of 200 metres. So aside from what's in and around the current pit shell, we've got 400 metres of vertical distance under the pit shell for future resource growth. And then on the right-hand side, we've got another cross-section here, and you can see that just about every hole on this cross-section finishes in mineralisation and finishes at around the current pit shell perimeter, which means that with some extensional drilling, we feel we'll be able to get further mineralisation under the pit shell, that there's some very easy gains here to increase the mineral resource again. The project has had met test work on it, and you can see some recovery curves there. A lot of these recovery curves are courtesy of Rio 2, which is to the north of us, with a head grade of 0.48, and they're achieving 75% recovery using a dump leach, and our column test work is showing 85% recoveries with a crush to 28mm passing, I think, within 30 days. So the oxide zones produce a very great recovery rate. So the value proposition, and this is where it starts to get really interesting. This curve here comprises ASX and TSX companies with gold projects with a minimum of 500,000 ounces in them, and they're pre any feasibility work. So it's a peer group which matches. You can see us, the orange column there, and we're valued at right now at around, I think it's around 40 bucks an ounce. The medium of the group is, checking the curve, $142 an ounce, and on the left-hand side it maxes out to above $200 an ounce. We think our project clearly is of a higher quality, and it should be heading towards the middle of that curve fairly soon. So that's value proposition 1. Value proposition 2 is this analogue. We've got ourselves here right now with a market cap of around 45 mil. We've got Saturn Metals, another heap bleach project in WA, valued at circa 300 mil. And then we've got the Phoenix project owned by Rio 2, which is 40 k's to the north of us, valued at around Aussie dollars 900 mil. So as we enter feasibility, we increase the MRE. That's a potential growth path that we see. That's value proposition number 2. Value proposition number 3 is we recently announced that Xinhai, a very large high-end EPC firm in China, has joined our register and will be appointing a board member to Flagship, and they bring the full suite of services from metallurgical testing through engineering, project construction and project management. So this gives us construction credibility and brings that capability onto our board and inside our tent, which is really important as we head into an environment where the queues for assays, mets, engineering, construction are going to lengthen with all the activity in mining. And value proposition number 4 is how do we fund the project? And here we have on this chart 2 projects. The Vulcan project, located 12 kilometres to the northwest of us, has a $15 million US funding line from Franco-Nevada for its feasibility. And the Phoenix project, 40 k's to the north, was funded fully for its construction by Wheaton Precious. So their construction costs were around $120 million, and Wheaton Precious put up a streaming line for them. So that's value proposition 4. And then to finish off, and this is what makes it really sweet, is this cost curve here is of Australian and New Zealand producers. It is first quarter this year, and you can see the Phoenix project, they're at 0.43 grams a tonne, which would be located in the first quartile. You can see the Vulcan project at 0.63 grams a tonne, located in the first quartile, and where our grade is 0.69 grams a tonne, so we expect to be somewhere down there. And at the end of the day, if you want to make money, you've got to be the lowest cost. If you want to sustain yourself through the commodity cycle, you've got to be the lowest cost. and that's what makes these projects work. Thank you.